Hello everyone. In this example we're going to be doing exercise number 2 from Unit 4 in AC201. In this example we have to prepare a statement of cash flows using the indirect method for General Bill's cereal company. The first item that we're going to take care of is all of our current assets and our current liabilities, because they are going to tell us how we have to reconcile our net income to our net change in cash provided by operating activities. So the first thing we need to do is figure out how much cash changed during the period. And as we see, General Bills has $990,000 in cash on its 2019 books, and they had $910,000 on their 2018 books. Well, I think it's safe to say then that cash increased by $80,000 during the period. And that is going to be our answer. Like when we do our statement of cash flows, we know that's the number that we're working towards. Let's figure out our other accounts. Accounts receivable has a current balance of $162,000. It was $152,000 at the end of the prior period, which means it increased by $10,000. Inventory is at $545,000. It was at $560,000 at the end of last year, which means during the year our inventory decreased by $15,000. Next up, we have prepaid expenses. Prepaid expenses is currently $85,000 on our books. On last year's financials, we reported $35,000 worth of prepaid expenses, rent, insurance, etc., which means that our prepaid expenses, which is a current asset, increased by $50,000 during the period. Accounts payable is listed at $225,000. Last year it was $160,000, so it increased by $65,000. Our short-term notes payable, notes that are due within the next year, is $160,000 on our current books. It was $165,000 last year, so we paid out some principal here. $5,000 decrease in short-term notes payable. And then lastly, we have our accrued liabilities, things like interest payable, salaries payable, etc. They are $250,000 on our books at the current time. Last year we reported $210,000 worth of accrued liabilities, which means they increased $40,000 during the year. So we have our change in all of our current assets, cash, AR, inventory, and prepaid expenses. And we had our change in our current liabilities, accounts payable, short-term notes, and accrued liabilities. We also have some other items here that we have to place on our incomes, or on our statement of cash flows. We have the net income for the year. We have the amount of cash that we put as a down payment to acquire new machinery. And then we have the balance of the remainder of the loan that we used to acquire that machinery, the mortgage. So we put $500,000 down, signed a mortgage for $300,000 to acquire in total an $800,000 piece of machinery. We received $200,000 in cash from the issuance of common stock. We paid $750,000 cash to retire bonds that we had outstanding which had matured. So it's time to pay the principal back. We paid $750,000 to our bondholders to retire these bonds. We sold a used shipping truck, and we did so for $25,000. But the truck was worth more, according to our books, than that $25,000 that we sold it for. We took a loss on the disposition of this truck of $10,000. So essentially what happened here is we got $25,000 in cash for the truck, but our book said it was worth $35,000, so we have to report a loss of $10,000. Our current year depreciation expense was $55,000, and we paid $15,000 in cash dividends to our shareholders. So with all of this information, all of the stuff that has to deal with our income, with our current assets, with our long-term debt, with our equity in here, plus all the stuff that deals with our current assets and current liabilities up here, we're ready to prepare General Bill's statement of cash flows. And the first thing that we're going to do is start with our net income. We're going to put this in the right-hand column. What was General Bill's net income for the year? Well, we have that right here. It was $1 million was their net income. But that net income contains income that stemmed from things that were non-cash, services or sales in this case, because they're a cereal company, that we provided, that we did on account. Non-cash expenses that we got to record, like our accrued liabilities or our depreciation, all of that stuff is included in that figure. Well, we need to adjust it so that it becomes the amount of that income that stemmed purely from cash, and that is our net cash provided by operating activities. The first thing you want to do always is add back in your depreciation expense. So we're going to go and we're going to add in our depreciation expense, and it was $55,000 during the period. If you have any losses or gains, you want to recognize them here. Again, losses decrease net income, but they don't decrease the amount of cash that you receive from the asset sale. So we got $25,000 from this truck. Yes, it was worth less than our book said, but that loss is stemming just from what we valued the truck at the time that we sold it. If we used a different depreciation method, we could have had a very different value, which would have changed the amount of loss that we had, but it wouldn't have changed the amount of cash that we received. So for losses and gains, you do the opposite of what you did on the income statement. This loss would have decreased net income. Well, we're going to go and we're going to add it back in. If we had a gain, we would subtract it out. Now we have our current assets, and our current assets are up here. They are cash, AR, inventory, and prepaid expenses. So let's deal with those first. Cash, we're not going to put in this adjustment section. The reason being is it's the number that we're working towards. That's why I've given you this information. These other three accounts, however, we are going to put into the adjustments in our operating section. We see that AR increased by $10,000 during the period. Well, if our receivables went up, that means that for the sales that we made, we got paid less in cash. More of our customers paid on account. So it is decreasing our cash flow. So for current assets, do the opposite of the change. If we had an increase of $10,000 for the change in the account, let's decrease cash flow by $10,000 because we spent an extra $10,000, we received $10,000 less in cash from the same amount of revenue. Same thing for inventories. We had a decrease in inventory. Well, if we have a decrease in inventory, that means that we spent less money making cereal, and if we've spent less money making cereal because we made less of it, that's going to increase our cash flow. And then lastly, we have an increase in prepaid expenses, and for our increase in prepaid expenses, we shelled out more cash to prepay for our rent, utilities, insurance, etc. during the period, $50,000 more, which means since we spent $50,000 more acquiring these prepaid expenses, our cash flow has to be decreasing by $50,000. For all of your current assets, again, it's always the opposite. If your change is positive, it's decreasing your cash flow. If your change is negative, it increases your cash flow. For the other three accounts that we are going to deal with, which are our accounts payable, our notes payable in the short term, and our accrued liabilities, they are current liabilities. And for those, you do the same. So for accounts payable, we had an increase. By how much? Well, accounts payable, we see here, increased by $65,000. If our accounts payable is increasing, that means that we are acquiring more stuff with debt. And if we're acquiring more stuff with debt, we are spending less cash. So increasing your accounts payable increases your cash flow because you have more cash sitting around that you didn't spend to buy all of those raw materials, etc. We had a decrease in short-term notes payable. Well, we paid more cash to pay off our note, which means it's going to decrease our cash flow. So let's decrease that by $5,000. And then lastly, we had an increase in accrued liabilities. And accrued liabilities increased by $40,000. And if our accrued liabilities increase, that means we have more stuff that we owe for that we didn't actually spend cash to pay for. So our cash flow has to be increasing. After you've gone through your depreciation, any gains and losses, all the changes in your non-cash current asset accounts, and all the changes in your current liabilities, you're going to sum up the total of your adjustments. So what we're going to do is just find the sum of all of the numbers that are in the left-hand column and place it to the right of our last line item. That's $120,000. So our total amount of adjustments we need to make is to adjust net income up by $120 grand. And when we do that, we take our net income, we add the amount of our adjustments. Our adjusted net income is $1,120,000. That is our net cash provided by operating activities. After that, we get to move on to cash flows from investing activities, and these only deal with any type of long-term assets that we have. Well, what part of our information in here deals with long-term assets. Well, net income, no, we already used it anyway. Cash down payment to acquire machinery. So cash is involved. It has to go into one of these above sections on the statement of cash flows, and it's to acquire machinery, which is a long-term asset. So we know that this guy has to be one of them. I'm going to change them blue so we know. We have the balance of mortgage payable to acquire machinery. Well, in this case, we're still getting a long-term asset, but we're not shelling out cash, which means we're not going to put it in the top part of our statement of cash flows, because what we're doing is taking on a liability for this. So this here, even though it is dealing with a non-current asset because no cash is involved, we're not going to put it in the investing section of our statement of cash flows. Cash received from the issuance of common stock equity, that doesn't go in the section because the section only does non-current assets. Retired mature bonds payable is long-term debt, that does not go in the investing section. Cash received from the sale of a used shipping truck, that sure seems like a non-current asset to me. That is a piece of PP&E, so we're going to have to throw that in there. Loss recognized on the disposition, there's no cash involved in here, plus we already used that in our adjustment, so the loss portion we're not going to put into investing. Depreciation expense, nope, we already use it. Then we have a cash payment of dividends to shareholders, where that relates to common stock, therefore is in a withdrawal account related to an equity. It is not a non-current asset, so all we have to put in here are these two items. So let's start over here with the proceeds from the sale of the truck, and again I'm going to put this in the left hand column. How much cash did we get for selling the truck? We got $25,000. We purchased machinery. How much did we pay in cash as a down payment to acquire that machinery? We paid $500,000. Well, what happened to our cash flow for these? For the sale of the truck, we got the cash, which means cash has to be going up. For the purchase of machinery, we paid out the cash, which means cash flow has to be going down. So let's make that negative. It should be negative $500,000. So in total, for items related to our long-term assets, we took in $25,000, but we paid out $500,000. So our cash used for investing activities, investing in the long-term growth of our company by buying plant assets, is negative $475,000. Next up, we have financing. And financing deals with anything that has to do with long-term debt or anything that has to do with an equity account. So let's go back to our items here. Net income, no, we already used. We already determined that one goes there. Balance of a mortgage payable. Okay, so mortgage payable is a long-term debt. But we're not getting any cash for this, right? Because we acquired machinery with it, which means since there's no cash involved in this particular line, it's not going to show up in the financing section of our statement of cash flows. Next one we have is cash received from issuance of common stock. Well, that's an equity account, and this section contains nothing but long-term debt and equity. Was cash involved? Yeah, we received it. So guess what? We know this $200,000 has to go in there. Let me turn that green. We have the cash payment to retire maturing bonds. Bonds, long-term debt. Long-term debt goes in this section. Was cash involved? It was. We paid cash to retire these bonds, so we know that has to go in there. We already determined that the cash received from the sale of the shipping truck went in the investing section, so it can't go here as well. The loss, all losses go in the operating section. No, not there. Depreciation expense, no, that went in the operating section as well. Then we have the cash payment of dividends to our shareholders. Well, that's related to equity. It's a withdrawal account, so it would go in the financing section as long as cash is involved. Is cash involved? Yes, we paid cash to pay those dividends. So now we have our three items that are going to go into this section. So let's fill them in. First thing I have listed here is the payment of dividends. How much did we pay in dividends? We paid $15,000 in dividends. We have the issuance of common stock. So we got cash by issuing stock. How much was that for? That was for $200,000. And then we had the cash payment to retire our mature bonds of $750,000. How are each of these affecting our cash flow? Well, we're paying to pay these dividends, which means if we're sending out money to our owners, our cash flow has to be going down. So let's make that negative. For common stock, we sold it to the public, to our shareholders, and they paid cash for it, which our business took in, which means our cash flow has to be going up. And then lastly, for the retirement of bonds, we had this outstanding debt. The bond's life came to an end, and at which point, the maturity date, we have to pay back the principal that people let us borrow in the first place, which means since we're paying it back, our cash flow has to be going down. And in total, the amount of cash that we used for financing activities is negative $565,000. So we have our three sections. We have operating, we have investing, and we have financing. Well, we got to find our net increase in cash right now. We can do that by just adding together the sum of our three different sections. It's not all of the numbers that you have in your right hand column. It is just the total amount you have from operating, investing, and financing. And with that, we see we have an increase in cash of $80,000. Well, let's make sure this checks out. We have to list our cash balance at the end of the prior year. That is in the information that we have above. Our cash balance at the end of the prior year was $910,000. We have to list our cash balance at the end of the current year. Again, in our information, it tells us it was $990,000. Does that make sense? Is that an increase of $80,000? It is. We went from $910 to $990. So this number that we got right in the very beginning, this increase of $80,000 to cash that we have right here, I'll make it red, I guess. That was our answer. And we knew our answer right from the beginning. So whatever number you come up with for your net increase or decrease in cash has to be equal to the change in your cash balance. So right from the get-go, you are going to know what the answer to your statement of cash flows is, what number you're working towards. We're not done yet though, because we have to deal with any non-cash items that we had, and we had one. It was here. We signed a mortgage to acquire machinery. Well, when we did so, make it purple, no cash was involved. We got the stuff at the time and we signed debt for it. Well, we still have to disclose to people, you know, okay, they're going to look at it and say your equipment account changed by a portion that's greater than, you know, the purchase price of your cash on here. What happened to the other stuff? Well, where's this $300,000 at? It's right here. We're going to put it in non-cash investing and financing activities and disclose to users of our financial information that we had a non-cash activity, which was the purchase of machinery by signing a mortgage, which explains why our equipment account is increasing at a rate greater than the amount that we paid to purchase the machinery up here.